The last time we saw this market signal, retirees lost a lifetime of savings in months during the Great Depression. And if a crash like this hits right when you retire, your savings won't have time to recover. So in this video, I'm going to show you whether this signal means a crash is actually coming, how your savings are facing much more risk than you realize, and what you can do right now to protect yourself without giving up returns. To start, I need to show you what's happening in the market right now and whether you should be worried about your retirement. This chart shows the size of the single largest company in the market relative to a company at the 75th percentile. In simple terms, it tells us how concentrated or top-heavy the market is. Back in 1932, concentration hit its highest level ever, and shortly after came the Great Depression and the single worst market crash in history. Then in 2000, levels spiked again, and what followed was the dot-com crash, wiping out years of savings in just a few months when the Nasdaq fell nearly 80%. And as you can see here, market concentration just hit a level we haven't seen since the Great Depression. And because of this, many retirees are worried the next big crash is coming. So the question is, does high concentration automatically signal an upcoming crash? Well, this next chart shows the forward one-year return of the S&P 500 compared to market concentration. If concentration did predict crashes, you'd see a clear pattern. But the randomness of the dots tells us it can't be used to predict crashes. So if that's the case, how do you explain our first chart and how does it affect your retirement? Well, this chart shows the volatility of the S&P 500 compared to concentration. And as you can see all the way to the right, even if concentration doesn't signal a crash, it does signal high volatility. And if you're retiring, here's what that means for you. This shows two retirees who face the exact same 15% drop for 2 years, but end up with completely different outcomes. Investor 1 experiences the 15% decline during the first 2 years of retirement. And when you combine the early market drop with withdrawals, they end up running out of money. But Investor 2 experiences the same decline, but in the 10th and 11th years of retirement instead of the first 2. And because it comes later, they're able to survive it. So even though there's no guarantee a crash is coming, if one hits right at the start of retirement, it can make you run out of money. But even if a crash does hit early, there are strategies you can use to keep it from wiping out decades of savings. This chart shows that same 15% drop for 2 years and how long it takes to recover based on how much you're withdrawing. If you were taking out 4% each year, it would take 28 years to recover your losses. But if you reduce that down to 2%, you'd be fully recovered in just over 11 years. So reducing your withdrawals when the market drops can be the difference between recovering in a decade and spending 28 years digging yourself out of a hole. But when you have bills to pay, you can't just cut your spending in half. That money needs to come from somewhere. And sometimes, the best place to take it from is a source many retirees never consider. When most people think about claiming Social Security, they only think about maximizing their benefit. But what they don't account for is the value of having an income source available that has nothing to do with the market. If the market crashes and you can turn on Social Security to help cover your monthly expenses, that's money you don't need to take from your portfolio. So even if claiming earlier means less monthly income, taking that pressure off your portfolio during a crash can be worth more than waiting. But if you don't have Social Security available to help bail you out during a crash, here's another lever you can pull. This chart shows the average returns of the Bloomberg Aggregate Bond Index versus the S&P 500. In periods where stocks are down more than 10%, bonds have averaged positive returns. So if your bonds are up while your stocks are down, you can take money from bonds instead of selling at a loss. But having said that, this strategy hasn't been perfect. In 2022, both stocks and bonds fell by double digits. So to add one more layer of protection, you can keep a small cash buffer. Having 1 year's worth of expenses in cash and 2 to 4 years in bonds can give you enough runway to survive almost any market drop without selling investments at a loss. But even if this strategy works perfectly on paper, it doesn't always work in practice. And it's because of one mistake that gets harder and harder to avoid the closer you get to retirement. This compares the price of the S&P 500 in gray to the net flows in and out of the market from everyday investors in blue. So when the blue area is above the line, investors are buying. Below it, they're selling. And these dotted areas highlight some of the biggest market drops. And as you can see, almost every one lines up with a big sell-off from everyday investors. So when you're retiring, it's not just the risk of a market drop you need to worry about. Selling out during a downturn can turn a temporary drop into a loss you never recover from. But the good news is there's one simple change you can make right now that can keep you from panic selling at a loss and still get the returns you need to fund retirement. This chart shows the regular S&P 500 in blue versus a version that only focuses on dividend-paying companies in black. If you invested $10,000 in each 20 years ago, you'd have done great with either option. But even if the returns look similar, let me show you how investing in the dividend version can completely change how secure your retirement is. This next chart compares how both funds performed in bear markets. Across multiple crashes, the dividend-focused S&P 500 dropped significantly less. It only fell 14% on average, while the regular S&P fell nearly 26%. So focusing on dividends can reduce the volatility in your portfolio, making it much less likely you'll panic sell during a drop. But even if you're not selling out of panic, you still might have to sell shares to cover expenses. So let me show you how to avoid this so you don't lock in losses that are hard to recover from. This chart shows the price of the S&P 500 using the blue line versus yearly dividends with the orange bars. During the 2008 financial crisis, the S&P 500 dropped over 40%. So if you needed to sell shares to cover expenses, you'd have been forced to sell at a huge loss. But when you look at dividends during the same period, they barely dropped at all. So dividends can give you the income you need to cover spending without having to sell shares while they're down. But dividend-paying investments are just one way to reduce volatility and still get the returns you need. There's another way most retirees never consider because it means investing in assets most people would never expect to see in a retirement portfolio. This chart compares the volatility of different asset classes since 2000. Bonds are the least volatile, equities are in the middle, and alternatives, things like precious metals and oil, are the most volatile of all. So if the idea is to reduce volatility, alternatives seems like the last thing you'd want in your portfolio. But adding them in looks a lot differently than you'd think. This shows the volatility and returns of different retirement portfolios. As you'd expect, more stocks means more volatility, but also higher returns. But this next set of portfolios shows what happens if you take 10% of each and replace it with alternatives. Across the board, volatility goes down and returns go up. And that's because alternatives aren't tied to the stock or bond markets. So even a small allocation adds diversification and can improve performance over time. But even after making these changes, many retirees still end up taking on far more risk than they realize. And it's because they forget to do one thing that keeps their portfolio from drifting out of control. This line shows what would have happened if you retired with a 60-40 portfolio 20 years ago and never touched it. By the end of 2023, your portfolio would have drifted to over 80% stocks. And today, that number would be even higher. And if you faced a crash with 80 or 90% stocks, that could mean losing hundreds of thousands of dollars more than you would have at 60%. But this green line shows what would have happened if you rebalance quarterly. For only one quarter in the entire 20-year period would you have drifted past 65% stocks. So rebalancing quarterly can keep you at the risk level you actually planned for without changing a single thing about your investment strategy. But even if you make all these changes, with everything going on in the world, you might still be wondering if you actually have enough to retire safely in 2026. So for the exact 4-step plan anyone can use to stop worrying about retiring in 2026, check out this next video.